Let's get back into the macro. Barry Knapp is a managing partner at Ironside's Macroeconomics. He got some great charts for us, some pretty deep dives into inflation. But Barry, let's just start with the subject that's going to be big this year, the market's insistence. No matter who says no March cut, the market keeps betting on it. I mean, I can't think of a time really in recent memory, other than maybe going into COVID, where the market kept pricing in cuts. Everybody's like, why is the market pricing in cuts? And then we got COVID. So should we be scared here or what?
Well, I agree with you, Oliver. The biggest head scratcher on my screens today are the almost 10 basis point rally in two-year treasuries, that is. You're absolutely correct. There was nothing in last Friday's employment report to justify a move of this magnitude. I do think underlying labor market demand is weak, but the unemployment rate remains relatively close to the cycle low. Average hourly earnings are above the Fed's comfort zone. And this morning's number provided absolutely no justification for a rally in twos either. Forget what all the Fed officials have said, because they can be trying to manipulate the markets and use their speech as forward guidance. But the fact of the matter is that non-housing services, the part of inflation they're concerned that is driven by wages, is running at a 6-month annualized. And that's all the rage right now, 6-month annualized, right? Every time Timmeros, the Fed whisperer at the Journal, talks about inflation, he uses a 6-month annualized. That's running at 4.4. Rents are running at 5.2. And the whole disinflationary narrative is completely reliant on a level of goods deflation, which is a second round deflationary shock coming out of China that's already starting to turn back higher. So those are running at, core goods are running at negative 2.4%. That's as deep as of a decline as we had in the early 2000s after China was admitted to the WTO, but it's unlikely to persist. Global supply chains are getting restructured. We see another supply chain shock, this time in the Red Sea. It's just a bad bet that the Fed's going to go in March at this point, unless you really get the data to cooperate. So to your earlier discussion about why would this be happening, near as I can tell, everybody's favorite trade in fixed incomeville for the year was the yield curve steepener, or the disinversion of the curve. And I do think it will disinvert this year, but we have some ways to go before we even start this easing process. And between now and then, I see a very narrow path for either treasuries to continue to rally or equities, certainly not together.
Well, that's what's so interesting about the uninversion, the disinverting, is that a lot of it came, like we talked about last time, when actually the numbers were beating expectations. The kind of usual uninversion through the actual cuts is like when the recession's hitting. So we're in this really interesting spot. You've got a couple charts I want to make sure to get to. To your point about the inflation at this juncture, the disinflation kind of slowing down, the inflation surprise. I love the city surprise indexes. Obviously, the inflation stopped surprising to the upside. It's kind of bottomed out now. That's the first one. And then we'll run behind it your chart that has Powell's inflation framework. So kind of take me through this. Firstly, this one, which, okay, we're not surprising big to the upside anymore for inflation, but we have stopped surprising to the downside.
Yeah, my caption around this was the only people that were surprised that inflation eased in the fourth quarter were FOMC participants, because, even if you look at how vol was priced going into today, meaning short-dated S&P vol, the market hasn't put a premium on inflation days for at least 6 months. So the market, is pretty wedded to this idea that we are in this disinflationary trend. My year ago note was the path from 9 to 4, meaning it was going to be a really easy path to just wash this goods inflation out of the market and expectations and get the Fed to stop. But here we are down around the bottom, and inflation, I'm certainly in the camp that the final mile is going to be difficult. As I said, we've got core services, super core services at 4 and rent at 5. Rent's going to ease a little bit in the next few months, but it's unclear it's going back to the pre-pandemic trend of more like 3. And if it doesn't, and we don't continue to have deflation coming out of China, then we're not getting inflation anywhere near the Fed's target, probably 3. at best.
So we've kind of the last mile really maybe not really tough. I don't even want to go that far, but tougher substantially than what we already got. Some of this shows up when you break apart the components, like you mentioned earlier. You went through some of them, like shelter. I want to bring up that chart because we had a lot of them trending lower, since the highs, but most of these are either still positive or are actually upturning to some degree. What is the most important line on this chart? You got super core services in red, all items in black, rent of shelter in the gray, and then core goods in core as well.
Well, as it pertains to the Fed's reaction function, it's that super core services number. That is the piece that they believe is caused by wage growth. Remember, there's a lot of FOMC participants who still worship at the altar of the Phillips curve, right? This idea that we need a higher unemployment rate, lower wage growth in order to get inflation sustainably towards their 2% target. And so that service piece, and this is paraphrasing Powell, the biggest cost for a service business is wages or labor. And so until we start to see wage growth, which sort of stalled out in the fourth quarter, the last couple of average hourly earnings increases were 0.4%. That year-on-year rate is 4.1. Until you start to see that coming down, you're unlikely to get the Fed to say, hey, we're cutting because we can, not because we have to, right? The have to is the unemployment rate goes up. And this is my 4 fours thesis, right? To get the Fed to cut to 4, to disinvert the curve, keep the 10-year Treasury note anywhere in the vicinity of 4. We need an unemployment rate above 4, and we need average hourly earnings decidedly below 4. Well, we didn't get any data last Friday or today to support that 4 fours quadrilemma, I'm calling it.
I like that, the quadrilemma. So a lot of the convenient that the 4s line up in such a way. Now, what about the wage side component and the potential for the strength of our economy to kind of reflate? We got to kind of answer the last one pretty quick because we're through time, Barry. But what's the timeline to kind of know, if that's happening? Because the super core services come down and then they rise a little bit here. What is that transmission mechanism timeline like to know if it's going to keep rising?
Well, we're going to have pressure on the shelter measure through the next couple of months. But, I just would, in essence, to get the Fed started in March, we're going to have 2 very, very weak employment reports. The next 2 have got to be big misses. We need the unemployment rate to move up. We need average hourly earnings to come down. And while I think that's the broader trend, I don't think that that's probable. So my longer term outlook is reasonably favorable for the equity market, but I still think the first half of the year is going to be the flip side of last year, where we started out strong and then weakened later in the year. This time, I think we're going to start out weak. And then when we get the labor market in better balance and the Fed can get started and disinvert the curve the right way, which is not long-term rates going up, it's them cutting and bringing the short rate down, that'll loosen the bank credit channel. That'll set the stage for us to move truly into the middle of the business cycle. And from that point, we can get what's called the healthy broadening out of the equity market, get small caps, get small banks to participate. Right now, you got to stick with tech and avoid anything really economically sensitive.
All right, there it is. Bringing it home to the trade. Very great stuff. Appreciate the conversation. Let's keep it going.
All right, thanks.
Absolutely. Really good charts and analysis from Barry Ironside's Macroeconomics.